Did you know India imports over 85% of its crude oil? This staggering dependency means global oil price hikes hit us directly. In just 1 year, the average Indian household can spend thousands more on fuel and essentials. This isn't just about your car's fuel tank. Higher crude oil prices can add nearly 0.5% to India's inflation for every $10 increase per barrel. That means your daily groceries, transport, and even clothes become more expensive. The Indian government also feels the pinch. High oil prices swell our import bill, potentially widening the current account deficit by billions of USD. This directly impacts the strength of our Indian rupee against the dollar. So, what exactly is crude oil? It's a fossil fuel, a raw material pumped from the earth, which is then refined into petrol, diesel, kerosene, and even plastics. It powers nearly everything around us. India buys crude oil from international markets, primarily priced in US dollars. Countries like Saudi Arabia, Iraq, and Russia are our major suppliers. This dollar dependency is crucial for understanding its impact. Global crude oil prices fluctuate due to various factors. Supply decisions by OPEC+ countries, geopolitical tensions, and global economic demand all play a huge role. These are constantly changing. When international crude oil prices rise, it directly increases the cost for Indian refineries. This higher cost is then passed on to oil marketing companies like IOC, BPCL, and HPCL. Eventually, these increased costs manifest as higher fuel prices at your local petrol pump. State and central taxes, along with dealer commissions, further add to the final price you pay. Let's talk about inflation. Fuel is a primary input cost for almost every industry. When transportation costs rise, it impacts everything from manufacturing to agriculture, pushing up product prices. For Indian households, this means a double whammy: higher fuel costs for personal transport and increased prices for daily essentials. Your purchasing power effectively diminishes over time. The rupee's dance with the dollar is fascinating. When India imports more expensive oil, demand for US dollars surges. This weakens the rupee, making future imports even more costly, creating a vicious cycle. A weaker rupee also affects Indian companies that import raw materials or export goods. Their input costs rise, or their export competitiveness can be reduced in the global market. The government's role is critical. Historically, they have managed prices through subsidies or excise duty adjustments. However, these measures can strain the government's budget or lead to revenue loss. Remember the concept of oil bonds? Past governments issued these to oil companies to compensate them for selling fuel below market rates. These bonds still need to be repaid, impacting current budgets. How do Indian companies react? Airlines like Indigo and SpiceJet face massive increases in aviation turbine fuel (ATF) costs. This often translates to higher air ticket prices for passengers. Logistics and transport companies, vital for connecting India's vast geography, also bear the brunt. Their operational costs soar, which is then passed on through higher freight charges. Manufacturing sectors, from cement to steel, rely heavily on energy. Increased power generation costs, often fueled by crude derivatives, mean higher production expenses for these industries. Even our farmers are affected. Diesel powers irrigation pumps and tractors. Higher diesel prices mean increased farming costs, directly impacting food prices and farmer profitability. The stock market in India reacts significantly. Sectors heavily reliant on crude, like airlines, logistics, and paint companies, often see their share prices fall during oil price surges. Conversely, upstream oil and gas producers like ONGC and Oil India can benefit from higher crude prices. Their revenue and profits typically increase, often leading to better stock performance. How does India compare to oil-producing nations? Countries like Saudi Arabia or Russia benefit from higher oil prices, boosting their national revenues. India, as a net importer, faces the opposite challenge. The Reserve Bank of India, RBI, plays a crucial role in managing inflation. When crude prices drive up inflation, the RBI might consider hiking interest rates to control money supply. This affects borrowing costs. Higher interest rates mean home loans, car loans, and business loans become more expensive. This can cool down economic activity, but it's a necessary step to curb runaway inflation. The Indian government also pushes for diversification into renewable energy sources like solar and wind power. This long-term strategy aims to reduce our dependency on imported fossil fuels. Electric vehicles, EVs, are another key part of the strategy. Promoting EV adoption aims to lower petrol and diesel demand, thereby reducing our oil import bill in the future. One significant risk is geopolitical instability. Conflicts in the Middle East or supply disruptions for major producers can send crude prices skyrocketing overnight. We've seen this happen often. Another factor is global economic growth. A strong global economy usually means higher demand for oil, pushing prices up. Conversely, a slowdown can lead to lower prices. Expert opinions vary on future crude oil prices. Some predict a continued upward trend due to underinvestment in new production, while others foresee stabilization with increased supply. The transition to green energy also adds complexity. While demand might reduce long-term, short-term imbalances between supply and demand could still lead to price volatility. What about the Indian government strategy for managing these price shocks? They explore long-term contracts, strategic petroleum reserves, and diversifying import sources to mitigate risks. Strategic petroleum reserves act as a buffer. India stores millions of barrels of crude oil underground to ensure supply security during unexpected global disruptions. This is a crucial safety net. Diversifying import sources reduces reliance on any single region. India actively engages with new suppliers to ensure a steady and diverse flow of crude oil, strengthening energy security. The Indian rupee stability directly correlates with crude prices. A sharp rise in oil can rapidly depreciate the rupee, impacting investors holding foreign assets or those planning foreign education. For global investors eyeing India, crude oil prices are a key metric.
high prices can signal potential macroeconomic instability, affecting foreign direct investment decisions and portfolio flows. The impact on fiscal health is significant. If the government decides to absorb some of the oil price shock through subsidies, it puts pressure on the national budget and can lead to higher borrowing. Conversely, if the government lets prices rise to reflect global rates, it can lead to public discontent and further inflation. It's a tricky balance for policymakers to strike. Many analysts suggest that persistent high oil prices could force India to accelerate its transition to a green economy. This is not just an environmental imperative, but an economic necessity. The energy sector in India is undergoing a massive transformation. Public sector undertakings like NTPC are investing heavily in renewable energy projects, reducing coal and oil dependency. The long-term outlook for crude oil could see a plateau or even decline in demand as electrification becomes widespread. However, this transition will take decades, with volatility remaining. For consumers, this means adapting to a new normal. Budgeting for higher transport costs and exploring public transport or shared mobility options becomes increasingly important. The RBI continues to monitor inflation closely. Any significant and sustained rise due to oil prices will likely trigger further monetary tightening, impacting all borrowers and savers. The global nature of crude oil prices means India cannot isolate itself. We are intricately linked to international events and market sentiments, making energy security a continuous challenge. Government policies promoting energy efficiency and conservation are also key. Initiatives like Ujala LED bulb scheme reduce household electricity consumption, indirectly easing energy demand pressure. Ultimately, managing the crude oil impact requires a multi-pronged approach: robust government policy, technological innovation, and adaptive consumer behavior. It's a collective effort for India's future. For Indian investors, consider diversifying your portfolio. Look at sectors that are less impacted by crude oil prices, or even benefit, like renewable energy companies or certain IT services. Investing in gold can be a traditional hedge against inflation. During periods of high inflation driven by crude, gold often performs well, preserving your purchasing power. Keep an eye on RBI announcements and government policies regarding fuel taxes and subsidies. These can provide early indicators of market shifts and potential impacts on various sectors. Review your personal budget to account for potential increases in fuel and daily essential costs. Smart financial planning can help you navigate these economic fluctuations more smoothly. Crude oil is a powerful force shaping our economy and daily lives. Understanding its impact is the first step towards smarter financial decisions. Stay informed and empowered. If you found this video insightful, please hit the like button and share it with your friends. Don't forget to subscribe for more deep dives into finance and the Indian economy.